Hi, everybody. Thank you all so much for joining us this afternoon. I am really looking forward to today's presentation, in which we're going to be discussing some of the differences between single-family homes and multifamily investing. So, single-family versus multifamily. The goal here is to cover some high-level differences. This is not, the point that I'd like to make here is this isn't a good or bad choice, right? The difference, it's really just options and learning about which of those options makes more sense for you. So yeah, we're excited to get going here. I also have the pleasure of hosting this presentation with our the #1 agent in Marshall Reddick, Josh Gutierrez, who lives in San Antonio. So since we have Josh on the line, we're going to be focusing on some property examples in Texas, because we'll have his input. We're going to do a little bit more of a Texas focus, but we do want to let you know that we can assist in single family homes and multifamily in any of the markets that we service. So just in case, for those of you folks that may be considering another market, we just wanted to make sure you were aware of that. Just to quickly introduce myself, my name is Vince Tomich. I'm an advisor here at Marshall Reddick. In my primary role as an advisor is essentially to learn as much as I can about each individual investor and help you guide you through your investment or the investment process, and to ultimately achieve your goals. I was born and raised here in Southern California. I have been in the real estate industry now for over 8 years, and I am a property owner myself. Actually, I own both a multifamily properties as well as single families. So I definitely come from the stance of some self-experience as well, or some of my own personal experience. And it's always nice to be able to connect with individuals who are seeking, weighing out these options and being able to add a little bit of personal info to help. So, prior to my role though as an advisor, I was a mortgage lender for a number of years, and that's really where I learned the value of leveraging money. I had a few investment properties at that time and became very interested in growing my portfolio. And that's when I discovered that Marshall Reddick is a company that can help facilitate this process. So, from that point forward, I was all in. Like I mentioned, I do practice what I preach. So I have purchased through Marshall Reddick. I have them managing the properties. I have, borrowed money with us, lent money. I'll kind of go over our services next, but definitely a big fan of all of the services Marshall Reddick provides, and also have used them. So that's always nice in case any of you folks are interested in diving into any of those services further. For those of you that are newer to Marshall Reddick, this is always a good time to kind of explain who we are and what we do. So I would consider us a full service real estate firm, and we have 4 primary services that we focus on. We have our real estate brokerage, our property management, our private lending, and our investment funds. So just to give you, to break those down a little bit further. So for our real estate brokerage, we help people buy and sell, whether it's a primary residence or an investment property. And we can handle that in any market that we have, that we're located in. And we'll go over those markets later in the presentation, but the nuts and bolts is we can handle the brokerage side as well as property management. So to kind of quickly cover property management, 99% of our investors who decide to buy with us, they have full-time jobs and dedicated to, their family and kids and work and other things. So they do need some resources to help manage that property. We would be able to handle that role, right? So what that looks like is marketing, marketing a property, doing showings, screening the tenants, doing any kind of maintenance requests or repairs, collecting rent, dispersing rent, obviously to the owner, any kind of end of the year tax docs that you're going to need to show your CPA. We would handle that, as well as the turnover, right? So when a tenant leaves and you need to do some light, what we call make ready work, we can handle that as well. So essentially, A to Z in terms of our services from a property management standpoint. Our third and fourth service kind of co-mingle here, but I'll kind of explain them separately. So private money lending is a huge part of our business. Basically, there's going to be two sides to that. There's going to be people who borrow money from us and people who lend money with us. So let me explain the people who borrow first. So this is very different than your conventional lender, right? So most of you folks may have experienced the conventional loan in the past, where you're, pulling credit, you're submitting all of your documents. There's a lot of back and forth questioning. This is very different in that this is asset based. This type of lending is going to be more primarily focused on what the asset is, how much it's worth, what kind of rent it could bring in, right? Things of that nature. So basically though, the typical borrower for us is going to be folks who may be doing a short-term fix and flip on a property. So you're going to buy a property, renovate it, and whether sell it or refinance. That's a big bulk of people who borrow from us. There's also individuals who may have self-directed retirement accounts. Maybe you want to buy a property within your self-directed retirement account. You're going to need a non-recourse loan. That's what private money can offer. In addition to that, there may be some situations where you don't qualify for conventional financing. Maybe you have more than 10 financed properties. Another great example of someone who would borrow from us. Now, on the flip side to that, the same way that you can invest in real estate from us or with us, we offer investors the opportunity to lend money with us. So you can be the bank, you can be the lender, and instead of collecting like a rent check from a real estate, from a piece of real estate, you would collect a mortgage payment from a borrower, right? And it's all the same borrowers I just went over, right? Those are the same borrowers that you would be lending to. Or, private money rates go anywhere from, let's say, 8 to 12%. So that's the expected return you would get. And you can lend money on a direct capacity. So basically one borrower, one lender. That's what direct means. Now, the investment fund, that's kind of, like I said, a little bit of a commingle there. But instead of lending money in a direct capacity, we now have a mortgage fund where essentially you can be a part of, and you would be paid out quarterly distributions. And the nice thing about the mortgage fund is your risk and your money is spread amongst multiple loans, hundreds of loans, as opposed to funding one specific project in one specific market with one specific borrower. So you really diversify your risk, and you also have the flexibility of being able to keep the money in as long as you want. Whereas when you're in a direct loan, you're subject to when that loan funds and having to constantly redeploy that money. So long and the short is that's a more passive way to be a lender or invest in money, and I'm happy to go over any of those services if it's not about brokerage. My role, like I said, ultimately as an advisor is to make the process of investing as seamless as possible, and that I do that by hopefully educating and introducing the key players that are part of the team that make all of this happen. So without further ado, some of the topics that we're going to cover tonight, again, single family versus multifamily. So why multifamily? Why is multifamily a good idea, and what does that look like? What is a cap rate, right? That's something that those of you who may have dug into some multifamily, or you may have heard that term cap rate before. Why single family? Why does single families make sense? We're going to talk a little bit more about property management, financing, and some property examples. Now, just really quickly too, feel free if you guys have questions and you want to type in the chat box, we'll do our best to get to some of those. I do want to let you guys know, in the event that you don't get your questions answered or we don't get to it tonight, I am going to be doing follow-up calls through the rest of this week. So you can expect a call from me. We can go into more in-depth conversations or make sure that those questions will be covered. We'll also be giving you guys our contact information in case you want to reach out and connect directly. But as far as tonight, a lot of what we are going to talk about is when we say, obviously a single family is a single family home with one family living in it, right? What you commonly see amongst your neighborhoods. But multifamily is kind of a broad term. Technically, multifamily is from a duplex all the way to a 300 unit, right? Specifically tonight, we're gonna talk a lot more about the 2 to 4 unit range. We will kind of touch on what things look like from a 5+ unit range, but I just wanted to kind of set the tone now of like when we are referencing multifamily, that's typically what we're referencing to. So in case there's any confusion there, just wanted to make sure we get that out and explain that now. So a little bit more about our footprint, right? Where Marshall Reddick is. So what you're going to notice here, we are located in 5 different states across the country. So we have offices in all of the designated areas here in a footprint, right? So we can help whether it's brokerage, property management. Our private lending actually spans across the country, but this is where Marshall Reddick has physical brick and mortar type of services. So you can see here, and as I mentioned tonight, since we have Josh on the line, the properties that we're going to go over, or some of the kind of the metrics we may use, are going to be a little bit more Texas focused, just as a heads up. So next, I want to introduce Josh Gutierrez. Josh has been an incredible agent with our company for many years. I've worked with him personally on many transactions. He's an awesome resource, especially all things Texas. He's done a ton of multifamily transactions, a ton of single family, and he brings a ton of experience from a leasing standpoint too. So I'll go ahead and let Josh do a quick intro, and then we'll dive into a little bit further into the presentation.
Thank you, Vince. Appreciate everyone attending tonight. I know we're all busy, but these are really cool topics to go over, especially right now in our market. There's a lot of low-hanging fruit if you're able to, move the branches out of the way, right? And you're able to capitalize on some of these deals. But I want to share a little bit about myself so everyone knows, the team and who you're working with. I'm one of the 4 original agents in our brick and mortar office here in San Antonio. I started off as a leasing agent when I ended my stint with Wells Fargo. I worked for Wells Fargo from 2003 to about 2017. So I was with them during the whole crash in 2008, and I worked in foreclosures. Supported a team of 12, and I helped those guys, navigate through the foreclosure portfolio. So you can just imagine, you got to see the good, the bad, and the ugly. Definitely the ugly. But I feel like a lot of that helped me set up for the real estate world, as I was able to see that the back end part, and then I was out in the field in 2017. Like Vince said, I started, leasing. What does that mean for you? You can leverage me, right? The skill set that I developed in my first years as a real estate agent, I really learned the market and what rents are doing and what rents call for. And I feel like that's been my strength as a sales agent now in helping out-of-state investors find turnkey rental property, because I'm able to tell you and I'm able to help you see what rents are really calling for out there in these properties here in Texas. I do speak fluent Spanish, so if you have a friend or family member that needs help and is looking into investing out of state or here locally, if they're a local person, I'd be glad to help them. I think one of the coolest things is, helping a fully Spanish-speaking client, and helping them buy or sell, and helping another investor at the same time, which is really cool. I've been able to connect them from both ends. But that's a little bit about myself. I'm a Marshall. I tell everyone I'm a Marshall Reddick lifer, and I hope to do more business with you guys here in the future and help you guys succeed financially through real estate. So the big question is, why multifamily, right? A lot of people, when they start in the real estate game or they've been in the real estate game, they still ask this question, right? Like, why do I choose multifamily? Why not a single family? Well, let's dive into that. One of the attractive things about multifamily is that you're able to gain, multiple rents at the same pace, right? So obviously you're dealing with 2 to 4 doors, right? That's kind of the niche here in the Marshall Reddick program that we use for out-of-state investors. We do focus heavily on 1, 2 to 4 doors. That's really like our bread and butter, for lack of better words. We do help people with 8 doors and up, but that's not very common in our portfolios. We have found that the 2 to 4 units is really, really something that has been proven successful for out-of-state investors. But the economies of scale when you're looking at a duplex or a fourplex is that the price per door is substantially lower than a single family residence, and we'll touch a little bit on that. Also, as you know, when you're looking at here recently, the during the COVID frenzy is what I call it, we had a lot of people looking at single families, right? Because you have primary homeowners that are looking, and you had investors. But with multifamily, because it's in a different class or it's in a niche on its own, you don't have a lot of competition, and that's one of the cool things about multifamily. Also, the cash flow. I mean, it touches a little bit about the economies of scale, but if more doors means more cash flow, right? If you have one door that's vacant, you won't have one you'll have one that's rented. So let's talk a little bit about the economy of scale. I usually say this when I'm talking to folks one-on-one is like, let's do the caveman math, right? Let's just break it down to simple math. If you were to purchase a fourplex at 850K, right? That's more or less what you're looking at in our market right now for a fourplex. And I'm being very gracious here because sometimes they're higher. But I mean, you can find them at 850K. Divide that by 4, you're looking at 212K, more or less, right? Per door. The rents that you could possibly pull from that is about 14 to 1500, and that's pretty common, right? So, and what I'm showing here is an actual real scenario of a real fourplex that's out there in the market right now. Okay, so 1500 times 4, you're looking at 6K in gross monthly income, 4,980 square feet, and all that is packaged into one property. Very easy. Right. Now, if you wanted to equate that, right, if you wanted to buy 4 separate doors in a single family, like one step at a time, this is what you're looking at on the right-hand side. So 305K purchase price is what you're looking at for similar square footage on this, right, per door. Gross monthly income, average rent right now in San Antonio for something that's, I'd say, in the 13 to 1400 square feet is anywhere between 1795, 1850, right? So this is on this example is on 1,440 square feet. So essentially, to equate what you have on the left-hand side, you would need 3.24 doors. And I don't know if you want to elaborate a little bit on this, Vince, because I know you put this together on this right-hand side.
Absolutely. So the way that we came up with that figure, right, is if you take that 6,000 number that you have in terms of a gross monthly rent, and you take 6,000 and you divide that by 1850, you're going to get 3.24. So essentially, you would need to purchase 3.24 doors to get this. Obviously, you can't buy fractionalized real estate. So to surpass what you have here on the right, you would need to essentially buy 4. But we just took the number 3.24, and then we applied that 3.24 times, a purchase price of 305. So if you needed to buy 3.24 single family homes, now the cost to do that is 988,200. So essentially, in order to achieve the revenue of this identical fourplex, you would need to spend 988 versus 850. So you see the price per door goes down as you buy multifamily. So that's one of these economies of scale ideas or visual that we wanted to explain of how that works in a real life situation.
Thank you, Vince. Also, one of the things that we didn't call out here is, it's already going to require some work to do a transaction that's a fourplex, right? Can you imagine doing it 4 times separately, right? That's an added bit of stress that you don't need doing it 4 times in a row. But by all means, if that's the strategy and plan you have, you're looking at it here. You may still be successful, which I'm sure you will be, but obviously that's going to require more work and more money, right? Now we were talking bullet point number 2 earlier about less competition. Less buyers are seeking multifamily opportunities versus single family opportunities. I can't tell you how many times during the COVID frenzy when it was super busy, a lot of folks had to submit, and you guys may have been one of these clients as well, investors, where you submitted offer after offer on a single family, and it was exhausting. And then the one time you submitted on a duplex, it got accepted. But that just speaks to the amount of attention that the single family homes get, because it's not just you guys as investors. You have single family like primary homeowners that are looking to live in those places as well. Also, it does take a little bit more experience. It's not a baby step when you're looking into a duplex or a fourplex. You have to have a little bit more experience, right, to mitigate the risks. So that kind of deters people from, maybe, you know what, I'll just do a single family for now, and, I'll look into a duplex later. The duplex market, obviously, there's not a plethora of duplex builders out here. Um, it's really kind of a limited supply. And when you do have a connection of someone that has duplex inventory, I mean, that's gold. And that's what you have with Marshall Reddick, right? So if you're ever looking for a duplex property, that's what we got. But in the general market, if you were out there in the wild, I mean, it's not much, right? You're gonna have to really look for it and have a connection. Um, Obviously, the price point entry is it's higher, right? And we'll elaborate a little bit on that as we move forward when we start talking about single family. But if you're buying 2 doors and it's double the price, it's going to require more capital to put down. Let's talk a little bit about cash flow. So a lot of people think like, oh, well, if I'm renting a door in Seguin or in New Braunfels, it's going to be way different for a duplex or a single family. But the general rent range for a 3-2 and in specific areas is applicable to both. It doesn't really change much, right? So when you're looking at the revenue streams, you really just multiply it because it's not going to change much. I mean, average range, and I'll tell you right now, just off the top of my head, when you're looking at rents for a single family of similar square footage on one of these duplex doors, you're looking at about 1750, 1795, and it's not much less, because on a duplex door, you're looking at about 1650 in the same area, 1625, right? So it's not much change. So with that said, more doors equates to more rental streams, and that improves your income, right? That improves your cash flow. So when you have a single family, if you do a rent increase of 5%, right? This is talking on the last bullet point here. If you do one price increase at 5%, that's an $85 bump. You can do the same price increase on 2 doors, and that's already a $165 bump, right? And your mortgage payment's not changing. You're doing the same 5% principal, but you're gaining double the income just off of that little increase.
Yeah, thanks, Josh. And that's a great point. And one other thing that I wanted to touch on here is income reliability. And what I mean by that is what's nice about multifamily is if one of the units is vacant or a tenant didn't pay, you do have the other unit to help offset your expenses, whether that be just your taxes and insurance or your mortgage, whatever you have. You're not just reliant on one single family, right? Or one occupant. And as you were mentioning a little bit more about the rent increases, a 5% bump is not is pretty common. So, a tenant, it's not going to get a tenant usually that's not enough to have them make such a drastic decision as to leave. So to be able to do that on one door is great, but when you have two doors and you can see that net income to you essentially doubles, that really helps your bottom line. But if you tried to raise $165 on a single family home to try to match that increase, you may have you're going to face probably some tenants that are going to want to vacate or change, all right? And I want to just kind of give you a personal example of this. When I purchased a duplex out in Texas in New Braunfels, what I experienced is at acquisition, at the time I purchased it, my expenses I was breaking even. And what I mean by that is my income was just barely covering or meeting my expenses. One of the reasons for that is that the rents were a little bit behind. They were a little bit behind what the market was bearing. I decided to do what, relatively a rent increase to kind of equalize or to get the property up to speed, which was about $150 a door. So going from, breaking even or just, maybe even slightly below to now raising it 150, but I have two doors now. So all of a sudden, to now go from $0 to $300 in cash flow was amazing to me. That was music to my ears. And that really kind of speaks and ties into this economies of scale. Imagine if that was times 3 or 4 or 5, that momentum could really shift for you. So I use that as just a personal example of something that I noticed with a small rent increase or a medium rent increase, and how that multiplied times 2 can be quite significant.
Absolutely. That's great. Thank you, Vince.
Yeah, absolutely. So wanted to talk a little bit about cap rates or capitalization rates. So I'm not going to go into a really long detail here, but I just wanted to kind of give you the rundown. So as you start to, for the folks that are seeking larger multifamily, and what I mean by that is 5+. The reason that I use 5 as a number is because 1 to 4 unit is considered residential. You basically are under the umbrella of conventional lending. When you go 5 units or more, you are now under the umbrella of commercial lending, right? So it's just a totally different set of guidelines and products and rules. And therefore, there's some other metrics and things that come into play here. So as you start to target those larger multifamilies, you're going to see a term or a rate of return called a cap rate. We offer or we display a cap rate on all of our properties as well, but it becomes more common in multifamily. And essentially what a cap rate is, it's the rate of return on a real estate investment property, and it's based on the income that the property is expected to generate. And to simplify that further, a cap rate is basically a cash-on-cash return that one would get, assuming that you bought the property all cash. So it's basically the return you're going to get when you buy it cash. And the reason for that is, when you throw a loan into the mix, it does alter that return, right? It's going to alter your cash-on-cash return because, for a loan, you're obviously leveraging some, so you're not putting all of the money in. And when dealing with non-conventional loans or commercial loans, there's so many different loan options. It's hard to do an apples to apples comparison with multifamily, and using a cap rate is a good way to accomplish that. Because of all of the variety of loan options, somebody may say, oh, I'm getting a cash on cash return of 12%, or I'm getting a cash on cash return of 4%. And those obviously sound way different, but maybe if you were to read into more of the financing associated with those deals, it would skew things, or it would change your position. So that's what cap rate is kind of a way to ultimately equalize when you're looking at multiple options. Okay. Next slide here, we're just gonna quickly talk about that when you do have a cap rate, this is also another figure that you can use to kind of pinpoint value. So when you're evaluating similar properties in similar areas, you're going to find that the cap rates also tend to be in a similar range. So this formula basically shows you that you can use a cap rate to determine what the value of a specific property would be. And you do this by basically taking the net operating income divided by that cap rate should give you, the estimated value. So this is, like I said, this is going to be more applicable to 5 units and up as a common method of evaluation. Where single families and smaller multifamilies, they more heavily rely on comparable sales in the area, right? More comps. But the larger multifamily, if you can increase that net operating income and you divide it by that cap rate, that's how you ultimately kind of force appreciation or force the increase in value. Happy to go into that a little bit more detail if anybody wants to have more direct calls, but that's just a little bit more of cap rate, and that's a metric that you will see on our calculations as well. Now, Josh is going to kind of pick it back up for why single families and tell us a little bit more about single families.
Awesome. Thank you, Vince. So now the second part of this is, okay, we've talked a little bit about multifamily. So now why the single family, right? Let's
Josh?
Sorry, can you hear me?
Yeah,
I
we
was on
can hear
mute.
you. Yep, we got you.
So the single family option, which is the second part of this presentation, is a very popular option, right? Especially for the first time investor. When you're looking at cost, it's very affordable, right? You're looking at one door. And just to give you some perspective on that, the cost is almost half of what it is, obviously, because it's 2 doors compared to one. And they're easier to maintain, right? Which adds a little bit of relief, right? It reduces a little bit of your anxiety when you're looking at the investment. Appreciation, single family homes tend to appreciate faster, and that's because you have more volume in that type of transaction, right? There's more single families being sold than duplexes. It's an easily tradable asset, right? So the single family home is like we had mentioned before, it's purchased by many people, many walks of life, right? You have your primary home buyers and you have your investors. It's just a lot more attainable with the single family play. But let's go a little bit into detail on these here. So affordability. Obviously, you need less capital to get into the investment, right? They're at a lower price point and less down payment. So let's talk about those three. So just to give you some numbers on like current pricing for a single family, average price right now. I mean, if you're looking at an investment, brand new build that we can find you, it's about 270 is the sweet spot, I would say, right? But most people are looking at a range of down payment for a brand new single family home of about 115 to 120K. Okay. If you were looking at that for a duplex at about the 484K range, you're looking at about I'm sorry, that's 121K for the duplex and 76K for the single family, right? So you're looking at a difference of about 40K around there. One of the cool things that a lot of the investors like, especially when they're looking to diversify, is that they don't need that much down payment. Financial guidelines say you can do 20%, right? On a duplex, you have to do 25% minimum. So that's what makes it very attractive, right? It lets you play real estate investor with less money. Also, the maintenance cost, it could potentially be less, right? I mean, you're dealing with one door, you're dealing with one unit, especially the way we approach the investment play here in San Antonio and in the Central Texas area. We tend to push a lot of the turnkey rental properties, which most of the times they have warranties, but nonetheless, because it's just one unit you're focusing on, you don't have to worry about that much maintenance costs, and it's easier to manage, right? Um, you focus like one door. It's vacant, you fill it in. It's vacant, you fill it in every single time. It's very easy to manage. On the appreciation, um, I mean, it's just based on numbers, right? So like there's more single family product out there. I mean, there's more single family builders out there. So there's going to be more comps for you to look at, right? So more transactions that create more comparables that are driving up your values faster. It's just that easy. Um, and if you're looking to offboard the property, let's say you're 5, 7 years into the game and you're saying, hey, I'm ready to offboard, there's just more buyer pool, right? You have more people looking at the single family product. Um, one of the things that we learned in recent years is that primary buyers, if they really like the home, and if you're buying in A and B class areas, they're going to pay more for the property because they want to be in the school district that they want to be in, and they want to be in the area that's more desirable. So that's another play, is that you might get a little more um, turn in the sale, right? You might get a little more cash just because it's in a more desirable area and you have a primary residence buyer looking at that investment. One of the things that I think is really cool about a lot of the San Antonio housing market, or just the communities, is that they're master plan communities, right? So most of the times they have amenity centers, hiking trails, all these cool things for mom and dad to do with their kids. So that makes it gain value much more, right? Because now you're not just talking about uh, the structure or the property, but you're offering amenities. So that will also play into your appreciation as well.
Yeah, and Josh, just just to kind of follow up on one point that you made there, I think it's really really critical that, with single family homes, being that the buyer pool is open to both primary buyers and investors, you do have those folks that are willing to quote unquote overpay or do whatever it takes to get themselves in that community or in that neighborhood or in that house, right? Because they have other reasons outside of investing. It's like, this is where my kid's going to go to school. I have a much closer commute to work. So you're willing to pay a premium, and that premium, when people are doing that, like you said, it raises the comps of your in that area, and therefore, can speed up appreciation. Whereas, a lot of investors may say, hey, I'll pass on that because the numbers don't work. And you'll see that mentality more for multifamily because it's not as common that someone buys a multifamily and lives in one of the units. It's mainly investors. So to your point, I just wanted to kind of hammer that home because
Yep.
that's a really key piece of information.
Yeah, the single family, I mean, it's just the more common play, right? I mean, most of the times we almost like mentally assume that when you're saying, "Hey, I'm investing in real estate," people are already thinking you're buying a single family because it's the most common one. Um, and it's, I know we're hammering this away, but it's a purchase option for both primary residence buyers and investors. And that's what makes it easily tradable, is like whether you're an investor or you're renting it out, I mean, you got all eyes looking at those properties. An interesting stat that Vince and I found was that 69% of the home sales are single family homes. And you can see down here that's highlighted, the majority of the housing stock in the United States is single-family detached houses. Of the total 128 million housing units in 2021, about 81.7 million were detached homes. So if that doesn't tell you it's an easily tradable asset, I mean, I don't know what else will. So lots of cool points, lots of good things about the single family play. You can easily get into investing. Like I said, in San Antonio, if you're looking for a single family investment, it's going to be roughly between, and I'm going to use this range, between 65 to 75K into down payment for deployment, right? In your down payment. So that's what makes it very attractive. And if you ever want to get out of the game, you have a lot of people that will shop and take that product off your hands. Vince, did you want to talk on this one?
Oh, sorry, I did what you did. I was muted too. So yeah, I'm gonna cover a little bit more about the financing here. So basically, this is a side-by-side comparison between single family and small multifamily, like I kind of have on the left side, and then you're gonna have your larger multifamily, let's call it 5 units plus, on the right side. So basically the nice part about 1 to 4 units, so single families up to 4 units, is that those transactions are considered residential transactions, and they follow standard conventional guidelines, which are typically more favorable to the borrower than conventional loans. So let's just kind of look really quick. This is high level. There's going to be more intricate parts to this, but I did want to point some of them out. So the down payment requirements for a single family investment or a multifamily. So for a single family home, you can put down as low as 20%. Technically, there's going to be some scenarios where you can even put down 15% as an investment, but you're going to need mortgage insurance. And the way that the rates look right now, I don't know if all lenders are subjecting themselves to that high of LTVs. So it's definitely safer, and what's more common that I see is 20% down for a single family. That's the minimum down payment, okay? When you go from a 2 to a 4 unit, that minimum gets bumped up to 25% down, okay? And what you're gonna find on our website though, as you look at single family homes and multifamily, we've kind of taken it a step further, or have increased those down payments per our pro formas. That doesn't mean you have to put that much down, but that's just for those of you that are familiar with looking at our website. You're going to notice a single family home, we assume a 25% down payment, when in reality it could be as low as 20. For a multifamily, we assume a 30% down payment, which in reality you can put down 25. So I just wanted to point that out there for those of you that may be looking at our website and kind of confused by that. The reasoning, you get a better interest rate typically at those different LTV marks or loan to value marks, as well as your loan amount's a bit lower, and it helps cash flow. For that multifamily 5 units and up, the minimum down payment is typically going to be 25 or higher, 30, 35. It really depends. There's a lot more gray area when it comes to those larger, that multifamily. The 30-year fix is a pretty common bread and butter loan program within the investment world, or within the primary residence world, right? But from a single family to a 4 unit, you can get 30-year fix on a conventional loan, and that's what we do the bulk of. As you get into larger or commercial loans, you're not seeing as much of that. There's a few options that do exist, but a lot of times you're seeing ARMs, which or better known as adjustable rate mortgages, right? Those typically have 3, 5, 7, 10-year fixed periods, and then they go adjustable. That's something that may make that purchase a bit more complex, or you may have to put a bit more thought into that, considering that in that fixed time frame you may be forced to refinance or deal with the rates, whatever that adjustment may look like. There's more favorable things too, though. You can get into interest only options where you are just paying the interest, so the down payment, the payment is much lower, but you run the risk of where if the asset goes down, you're right, you're not paying any principal. So you could find yourself in an upside down situation, right? So those are things to kind of be cognizant of. And DSCR, debt service coverage ratio loans. So that's not as, where a conventional loan, we're going to really focus in on credit, income, assets, what you do for work. Those are all borrower related questions, right? Whereas DSCR, debt service coverage ratio, that's more about what does the property bring in? How much debt, how much is the amount you're borrowing? What's that equate to in a monthly payment? And how much income would the property bring in? If it meets a certain ratio, the lenders are not as concerned with, what it is you do for work and why your tax returns are showing you're not making the money that you're, claiming you are, right? So things like that. That's those are just more intricate loan products. Going back to the 2 to 4 units, typically, as I mentioned earlier, there's more favorable terms for the borrower. So there's just a lot more oversight or regulations that protect borrowers. Whenever you're in the conventional lending world, there's a lot of regulation, due to the 2008 crisis that the government got involved and really set a lot of parameters to make sure that conventional borrowers are not finding themselves upside down or in real trouble, right? It doesn't mean you can't get into those kind of situations with conventional loans, but there are definitely more protections in place, right? Less points, longer fixed periods, no prepayment penalties is typical, right? Whereas on the flip side of that, on the larger or conventional, commercial loans, you're typically paying more points. There's less favorable terms. There are early payoffs. There are features to the loan that you really have to be aware of and understand before committing to them, right? So these are just some high levels. Like I said, there's going to be more specifics, and it's going to be property detailed or property specific, I should say. But here's just wanted to point out some high levels between the two. And really the summary of what I wanted to kind of bring to the table here is that if you do want to dip your toe into multifamily, right, that 2 to 4 range is a really interesting range because you can get the multiple doors, but also still be protected and held to those advantageous conventional guidelines. One thing I do want to mention from a conventional lending standpoint is you can only have 10 financed properties, right? At that point, a lender is not going to allow you to do another one unless it's your primary residence. So for that purpose, you basically, here's 2 extreme ways of looking at this. You can buy 10 single family residences and have 10 doors, right? Which is awesome. That'd be amazing. 10 streams of income. You could also, if you wanted to take it to the extreme, you can buy, in a conventional world again, you can buy 10 4-unit buildings, right? And you could have 40 doors. Those are both allowable. You can do both of those, right? So you could have 10 doors or 40 doors. So something to keep in mind. So those of you that talk about scaling and I want to go faster and I want to get more and, multifamily is a good way to do that. And you can leverage the conventional to the point of you've maxed out your conventional loans, and then you have to start going to these more commercial style or different financing options to expand further. So I know that was a lot, but I know financing is a big topic or a big point in this presentation. So we wanted to make sure we cover some ground there. And Josh, I think you were going to go ahead and talk a little bit more about acquisition prices and kind of just general cap rates for the area.
Yeah, and just to give you a general idea of like, okay, what am I looking at if I'm trying to, invest in the Texas region, in the Central Texas area? And we wanted to give you, just a quick snapshot of what you're looking at if you're looking at a 2 to 4 unit A and B class property in the Central Texas region. So I put San Antonio, New Braunfels, just because they're the bigger markets that we work out of. Seguin is also one, but I didn't, I kind of hash it into New Braunfels as well. And if you're looking at a 2 to 4 unit duplex or multifamily, like 4-unit fourplex, that's going to be anywhere between 500 to 850K. That's what you'll see. Okay. Expected cap rates. It's not those days where you would see a cap rate of, definitely not the market to see a cap rate over 5 unless you're looking at a C class, and that's kind of dangerous, right? Because it's like, you're going to have to, there's a give and take there. But if you're looking at A class, which is what we focus on, A and B class, because that gives you the better appreciation, better school district, less crime. In San Antonio, New Braunfels area, you're going to look at a steady 3.5 to 4.5% cap. And that's a steady Eddie cap. That's a true cap. A lot of the times people fall into the trap of like, man, I'm looking at these numbers and, they're telling me over here they're going to give me a 7% cap. Yeah, but the property's in a horrible area. So it may be true on numbers, right, that you'll get a 6 to 7%, but with the maintenance and the vacancy, you're getting demolished month after month.
Yeah, and Josh, to that point, a lot of what essentially cap rates represent is risk. The lower the cap rate, oftentimes you're buying in markets that have high growth, so the price points are higher. People are willing to pay more for that consistency, and therefore you drive down the yield. You have a little bit of a lower yield, whereas higher cap rate markets oftentimes is associated with a bit more risk. And in order for people to buy there, they need more of a return. So it's definitely, there's a risk component to that figure. So it's not always about just trying to find the highest possible number that works, because not all the time does it make sense to go after the highest risk, right? So there's just
Very
something
true.
else to throw into that equation there.
Yep, that's very true.
Yeah. Okay. So for those of you that are just, we just wanted to quickly kind of go over, these are the conventional loan limits or loan amounts. There's the conforming on the left. So this is 1, 2, 3, and 4. So these are your conforming loan limits across the country. So basically anything under these loan limits you can purchase, and then sometimes you folks may live like us, or should I say myself, here in Southern California. We live in what's considered a high cost area, so they have what's called high balance loan limits. So there's kind of a asterisk next to these loan limits if you live in one of these areas, right? So for example, for us, like if you wanted to buy a duplex, as long as it's under, the loan amount is under 1,394,775, that would be a conventional, conforming loan. Above that would just be considered jumbo loans, and there's a little bit of a different guideline. So this is just to kind of give you guys a range of what to expect. So as you go up in unit, they give you a bit more grace in terms of loan amount. So something to just point out there. I do want to let you guys know Reed Hazard has been our preferred and mortgage lender for almost 20 years now. He's worked with hundreds and hundreds of our clients. I'm sure some of you on the call do know Reed, and I've worked with him in the past. Reed's an amazing guy. It would be an awesome resource. He's well-versed, obviously, in single-family homes, but as well as multifamily. He has connections to do even loans that are maybe not your standard conventional. He's just a great resource for financing. And, in a time like this, when there is so many different options for financing, it's always good to talk to somebody who really has their fingers on the pulse and understands the options that are available to you guys. So Reed Hazard, there's his information. I wanted to quickly just let you guys know a little bit more about our property management. So, we do have a little breakdown here from single family all the way to 30 plus units, and how there's tiers of management fees, and how that goes in a downward direction based on the amount of units. So as you get more units, the management fee does go down. Essentially, there are two main fees are going to be our monthly management fee, which is going to be dependent on how many units and what market. And then our other fee is going to be our leasing fee. So whenever we have to place a tenant into a vacant property, we would collect 50% of 1 month's rent. That would be our fee to do the background checks, the showings, and all of the efforts for that leasing agent. And then you only pay those fees when it becomes vacant again. So if that same tenant stays for 4 years, you don't have to pay a leasing fee for 4 years. So that's a little bit of how that process works. But essentially it's, what does property management actually do? And I think it's really important. It's not just about, collecting rent when things are going really smooth. It's more about, knowing the rental laws and issuing proper disclosures. Long and the short of it is make sure to keep you out of court, keep you allowing to do what you do for work and spending time with your family and friends and doing the things that you want to do, and not the minutia involved with the day-to-day of operating and managing a property. For those of you that have done this for many years, you probably know that there is quite a bit of work, and even there's some work managing property managers. You just have to make sure things are going as planned. So to have that service, in my opinion, is crucial. And we like to just definitely advertise that we only make money when you make money, and so there's no rent. If there's no rent collected, or should I say, if there's a vacant unit, then we don't charge a management fee. We also use all of our outside vendors to do the work, so there's no in-house maintenance. And the reason that that's important is the maintenance, repairs, or the requests that we get from tenants is not a profit center for us. We don't make money from that. There's no upcharge. There's no Marshall Reddick division that profits from things breaking or from, essentially your expenses. We have third-party vendors that service all of those requests, and then you see those invoices direct, which is really nice. I've had property managers in my time that have a maintenance division or a profit center, and it does kind of create a conflict of interest there. So we want to make sure that that is not the case. And Josh is just going to quickly go over a couple of properties here. So I wanted to turn it over to him just to kind of high level go over a few, and then we'll come to a close here.
Yeah, more than anything, all the properties that we're going to go over here in just a bit, you can find all of these in our Marshall Reddick website when you go under properties, and you'll be able to see a lot more in-depth like photos, and you can toggle with the numbers. But I'm just going to share a few of these that are available that I think are really hot, that are a great opportunity for investment. This particular product here is in the Sydney Cove duplex community. And I'll say that again if you guys are taking notes. Sydney Cove duplex community. And that's in North San Antonio in a small suburb called Schertz/Cibolo. This is an amazing product. It's a 3-bedroom, 2-bath on each side. Potential for rents, and I think we're getting rents right now between $17.95 and $18.50 on these single-story units. They do have bigger units. I don't have it here. And those units, so these, as you can see up top, they're $545K. The bigger unit, which is a 2-story unit with a master down, is also available, and it's at $575K. It's a very small private community of about 27 duplexes. They're on their last leg of the final phase. A lot of these are going to be available in early fall, late fall timeframe. But this is an amazing product because it's an amazing school district. The Schertz-Cibolo School District is a very coveted school system that a lot of people want to be a part of. One interesting fact, because I don't want to take a lot of time, this duplex community is in that particular zip code is the only duplex community that's a brand new build duplex setup. So it's got its own niche. There's no other duplex community like it in that whole zip code of 78108. But our vacancy time frame is very low. It's anywhere between 10 to 21 days. And I'm being very conservative there because it's sometimes less. I'm gonna go to the next one. So everyone during the COVID frenzy was like, I want a duplex in New Braunfels, and now we have them. So they're going for 545K. An amazing thing that I like about this, and I even showed it to Vince, and he was like, I just, it doesn't make, I don't know, is that real? The the tax rate is 1.53%, which is unheard of in Texas, right? Because you usually have them above 2%. And a lot of people say, oh, well, the taxes are too high. Well, these are at 1.53. It's a great tax rate. This is also part of their final phase. It's already in an established duplex community. Amazing location where there's a lot of growth. It sits right on a highway named 725, which is the original road from New Braunfels to Seguin. So just amazing growth that's happening in that stretch and that corridor. And we have plenty of inventory left for investors. The community, for the note takers out here, is called Samuel's Court. Samuel's Court duplexes, okay? And this is also on the website. If you look it up and you fix your filters under duplexes, new construction, you'll see this come up right off top. Now to switch it up, because we are talking about a multifamily and single family, I found a couple single families that I think are gems, right? As far as price points go. To find a brand new single family home in Northeast San Antonio at $259K is a pretty rare thing, and it's in a great community. This particular property is right next to the Amazon distribution center in the Northeast corridor and right by the Tesla battery plant. So there's a lot of room for appreciation. We do manage 2 properties in this community, which is Horizon Commons, right? This is a Rosh Coleman build. So this is what you're looking at as far as like price point, $259K. And you guys know this is a buyer's market, so we can get a little bit of wiggle room on that price on this particular one. And you know, that comes also with some concessions, right, to help you with your rate buy down. This is just to give you an idea. It's 1,459 square feet, 3-bedroom, 2-bath. And just to give you guys a heads up, everything that I push investors to or recommend is always going to be a 3-bedroom, 2-bath. I never go out of that setup. The last one that I have to share with you guys is in the city of Seguin, which is east of New Braunfels, south of Austin, which is a very hot market. Similar price point, $257K. This is a DR Horton build, right? It's in a community called Swenson Heights. This whole area, extreme amount of growth. I mean, it's just booming in that area. It's got amazing finishes. You can see all the pictures in the Marshall Reddick website. This is also located in the Guadalupe County, which is the low part of the tax rate. Brand new build. Comes with a 1-2-10 warranty. So if you're looking for a very safe and sound investment, this is one that I would definitely look into as well.
Awesome, Josh. And just to kind of close out, there's some frequently asked questions that we get, and I wanted to kind of cover them really quick. So one of those is, what's the largest multifamily I can buy with conventional financing? Great question. So that is a 4-unit. Conventional, basically conventional is going to be the 1 to 4 unit range, and then anything above that 4-unit is going to be considered commercial. So that's what that would look like. Another one is, what are the advantages of single family investing? So to kind of put it in bullet points, easier to manage, or for single family, easier to manage, greater potential for building equity, and lower price points. It's typically what you're going to see there. Now on the flip side of that, what are the advantages to multifamily? So higher returns, income reliability, and like what I mean by that again is by having multiple, not relying on one family or one unit to pay for the rent, diversified tenant mix, and typically insulation from, some market conditions. And then the last is, I'm contemplating a 1031 exchange. Can I exchange a single family into a multifamily or vice versa? the answer to that is yes, you can. So a lot of times people are caught up in the 1031 exchange term like kind. So as long as you're trading an investment for an investment, that like kind could be a single family for land, or a 5 unit for a single family, or vice versa, a single family for a 3 unit, right? So that can be interchangeable. We do tons and tons of 1031 exchanges. I've worked with Josh many times on those. We have a great 1031 exchange accommodator as well for any of you those that may be interested in having that conversation. It's basically another party that helps with the 1031 exchange. For those of you that may be unfamiliar of what a 1031 exchange is, it's basically a tax maneuver in which you defer the capital gains that you would pay. So when you bought a property and it goes up in value, and if you just sell it and keep the money, you have to pay capital gains tax. This is a strategy in which you can defer that by as long as you use all of those funds to buy more property. And there's another third party involved, the 1031 exchange accommodator, to help with that. So happy to go into that in more detail. For those of you, that are interested in more education, all of our education is free on our website. We have webinars like this, guides, articles, other videos. So I encourage you to go take a look at, and you can learn and review at your own leisure. This is my contact information. For any of you folks that do want to set up a call, I'm happy to connect you with Josh or any of our agents in other markets if you have interest in maybe exploring some of our opportunities. Again, I want to thank you guys so much for taking the time. It's my pleasure, and I want to thank Josh for his time tonight and explaining all the information he had to offer. So thank you guys all so much.
Thank you, Vince. Thank you, everyone. Have a good night.
Have a great night.